Ilya, it's a pleasure to have you with us today. I would love to talk to you about some of the insights that you have as part of the venture capital initiative from Stanford University. But first and foremost, maybe let me welcome you back to your alma mater, London Business School. Maybe can you tell us just a little bit about your interest, your research interest and interest beyond academia?
Thank you, Gary. It's great being back. I studied at LBS many years ago, between 1999 and 2004, in this beautiful building, in Regent's Park. And then I went to Stanford. And I've been a professor of finance, professor of private equity and venture capital since then. And about 7 or 8 years ago, I founded Venture Capital Initiative at Stanford's Graduate School of Business to promote research on venture capital. Because the truth is, not only we don't know much about venture capital, but the venture capital industry is semi-secretive, quite opaque. And I think over the last 7 years, luckily, our team at Stanford has achieved a lot of interesting results and a lot of interesting outcomes, including on corporate venture capital.
And this is brilliant, because what I would love to talk to you about is exactly this topic. And I think, as you mentioned, private capital is private, and so we might not have a full knowledge of it. And within that space, corporate venture capital is increasingly an important part of the ecosystem, but maybe one that is the least understood. Maybe you can start off by just giving us a sense of the ecology, the magnitude of it. How many corporate investors are there? A little bit a sense of what's the magnitude of this phenomenon.
First of all, you're absolutely right. First, corporate venture capital, CVC, has becoming increasingly more important. Just about 10 years ago, there were fewer than maybe 250 corporate venture capital initiatives. These days, there is over 1,000 CVC initiatives around the globe. And I think more companies starting CVCs every single day. Second is that the venture capital industry is private, as you said, and opaque. And also, venture capital firms, for example, institutional venture capital firms, are structured differently from the way traditional financial intermediaries are structured. But even relative to institutional venture capital, corporate venture is different. And an important point to keep in mind is that while institutional venture capital firms are kind of similar to each other in many ways, I've now studied more than 200 CVC units, CVC groups, CVC funds very, very carefully, in depth, like case studies. They're all unique. They're all different from each other.
So this is an area that I would love to learn a little bit more. When I talk to some managers, they tell me the most counterintuitive thing to do is to take our hard-earned money and give it to startups. Some of them want to compete with us. And it takes a different way of thinking and a different way of designing and organizing such efforts. I know that this is a topic that you've studied very carefully. Can you maybe tell us just what are the key dimensions one should be thinking of, and then maybe we can go into how to put them all together?
Well, yes, you're absolutely right that giving money to startups is a very different proposition to standard, traditional budget allocation process, traditional projects that especially large companies have been traditionally engaged in. When we think about giving money to startups, we need to first of all think about our objectives. For example, companies might have a defense objective, which is they're trying to defend their existing business lines. Or companies might have an offense objective, for example, to compete with incumbents or compete with newcomers, or trying to identify new business lines. What I observe is that to be successful in CVC, first, companies need to have a very, very clear objective. Now, I often consult with or work with, and of course research, corporate venture capital units. What I'm amazed at is very often the parent executives who supervise, sponsor CVC units very often do not have a clear objective for CVC, especially clear long-term objective, because it's a long-term game. It's not over the next 3 months, 4 quarters. It's a long-term multi-year objective. One word that I would like those who are in charge of CVC or thinking about CVC to remember is design. Based on all my research, CVC's units succeed or fail based on how they're designed. And the truth is they should be designed very differently from traditional corporate business units. So very often I'm invited to help, I tell corporate executives, I will not be able to answer the questions, how you should design the CVC unit. What I will be able to tell you is, first, what questions you actually have to answer. Like I have a list of 50 questions, that many, that you need to answer. And second, I definitely will tell you what you should not do. Because what you should do depends on objectives and on the number of constraints and preferences that you have. But independent of those constraints, there are a number of design decisions, for example, decision-making process decisions or the subordination decisions or the compensation decisions that are unlikely to lead to success.
And so I would love to maybe have a chance to, I invite people to kind of visit the Venture Capital Initiative and the fascinating reports that you've written on the topic, but maybe unpack one or two issues just to give people a sense of the level of depth that goes into that. And so one question that always comes to mind has to do with what are the objectives, and specifically how to think about financial versus strategic returns. It's a question that comes up time and again. Can you maybe share with us how should one think about it, and maybe what are some common pitfalls one should be mindful of?
Absolutely. Well, first of all, let me step back for a second and tell you that we don't study corporate venture, and indeed other venture firms and other players in this ecosystem just by looking at the data. Of course, as scientists, we believe data. In the venture capital world, one needs to be careful, and we always carefully check every single data point that we get. With the corporate venture capital, what we do, we go inside corporate venture capital units and we talk extensively with the leaders of those units. So those are in-depth interviews following a very particular protocol so that we can learn a lot, something that is not available on their websites or from hard data. And also we can learn stuff that then we can compare with other peers in the corporate venture capital world, with institutional venture capital firms, and then we also can compare to eventual outcomes. Now to your question. I believe that objectives, as already mentioned earlier, are very important. Truly, truly important. And I'm amazed how often corporate executives don't have a clear objective. First, as already mentioned, but I would like to emphasize, corporate venture capital objectives must be medium to long term. If you have only short-term objectives, or if you care only about short-term KPIs, especially if you're a public company, that's a danger for having a successful corporate venture capital unit. Second, amazingly enough, in about a quarter of cases, we've been told that our unit mostly has only financial objective. For example, IRR, return on capital, and so on. Now, the truth is that it's unlikely to be successful, with some notable exceptions when that corporate venture capital unit is really outside the parent structure, and the parent is perhaps the single limited partner LP in that CVC fund. Why it is unlikely to be successful? First is because those CVCs compete with everybody else, with other investors. Well, they compete with top-tier institutional venture capitalists. It's very tough. Second is that the corporate venture capital typically is a very small part of the parent structure. Like most of the assets under management of corporate venture capital units are not really in the 10K income statement, balance sheet, and so on of the parent company because they're too small. And so financial, even if the CVC unit returns 5x or 10x, which might happen, it's not going to be that visible. Where it could be visible, and dramatically so, and there are obviously some very successful examples, by helping the company to achieve a number of strategic objectives. For example, I know companies where, with the CVC help, in 5-year time, up to a third of the entire revenue of the company got from the initiatives started by CVC. So that is an impact. And it's way beyond the specific financial performance or specific assets under management of the CVC unit. So to sum up, long term, and then I cannot tell you if you're parent executive whether you should pursue a specific objective, whether it's defense, offense, and there are other possible objectives, but you have to think through what is the long-term objective for the CVC unit that you must have.
So this is very important insight, and I think what you're telling us is even if the CVC achieves a top rate return on the AUM, that's not going to move the needle for a corporate. It's really kind of impacting the way the corporation is doing business. You said up to a fifth of their product line is affected. I think that is a very important way of thinking about it. If I can kind of, there's so many dimensions I can think of along the design, but maybe one that makes this come to life. So we talked about the kind of 30,000 feet, what are the objectives? Where objectives translate into reality is in the investment committee. And I know that you have worked very closely and have some deep insights into that space. Can you maybe tell us, in the spirit of what you talked about earlier, what are some red flags and what might be some things that actually enable a very effective process?
Absolutely. Just first of all, just to confirm what you've said, Gary, is that financial performance per se is not everything. I know of some successful CVC units financially that have been disbanded by their corporation just because the nature of the corporation changes and financial performance then would not really save the corporate venture capital. Indeed, the way the investment committee works and more broadly the decision-making process is critical for success. When we think about institutional venture capital, then most of them are organized as partnerships. Research shows between 4 and 7 partners, even though sometimes, of course, firms are much larger. And they do have investment committees, and sometimes partners make decisions unanimously, which means really everybody has to be enthusiastic about the deal. Or sometimes there is a formal majority vote and so on. When we come to the corporate venture world, then typically the decision-making process consists of 2 steps. The first step, or the first stage, is the internal decision by the corporate venture capital team. And within that decision, the investment partners, even though they're typically not called this way, of the CVC team have to make a decision whether they're interested in that specific investment. And the way they come up with this decision, in fact, is very similar to the way partners at the institutional venture capital firm make decisions. But while for the institutional venture capital firm, that's the end of the story. If they do not like the deal, that's that. But if they like the deal, then they give a term sheet, okay, an offer to invest. For the CVC, it's often only the first step. The second step is that they actually have to go to the real kind of investment committee, which is the parent investment committee. And I observed a lot of situations which I think are suboptimal. So several suboptimal situations. One, the firm has one investment committee for all sorts of outside investments. For example, if we think about a majority investment, which is, let's say, an acquisition of $500 million, or a minority investment of $2 million in a small, struggling, fledgling startup, it's going to be the same investment committee. It is suboptimal from all points of view. Second example is CVC leadership often is not a part of that second investment committee. Now, they, of course, present the information, they provide information, they try to convince, but they're really beggars. So they're asking to approve the deal. The investment committee will consist of senior executives of the parent, sometimes presidents of the business unit, CFO representative, CEO, the CEO representative, the head of strategy, jail counsel, and so on. And our research shows that on average is between 5 and 7 people on the investment committee. Now those people, first, they don't really have an expertise in the world of startups, which is so different from their day-to-day life. Second, they typically make decisions that are much larger than $2 to $5 million investments. So for them, in fact, it's time wasted in many ways. And what it leads to is that, first of all, it dramatically slows down the process. In fact, many CVCs told me that one of their challenges they cannot invest in the best deals for a simple reason that they will tell the company, we love you, but the truth is you're so successful and you're already finalizing your round. Well, you need to give us like 3 months. And so they lose a lot of deals. Second, very often the most interesting deals are the ones that are controversial at the time, when they're small startups. And either the parent level investment committees don't really understand those deals because they don't see direct applications for their company, or in fact they never see those deals because at the internal first stage CVC level, the CVC leaders decide not to bring those deals forward, knowing that they're controversial. So very often I've been told, well, we socialize the deals. We've never been turned down because we just don't bring the deals that are unlikely to be approved or likely to be looked down upon. That is very, very unfortunate. And while there could be many solutions how to deal with that, I just think that if you happen to have a CVC where the actual decision is made by those who don't have a specific expertise in the venture capital, my suggestion would be to step away from that. It doesn't mean, and that's a very important point, it doesn't mean that parent executives should not play a role. I actually think that they should not give complete free rein, like in the institutional venture capital. So they're not really LPs. They are strategic partners. They are sponsors. They, in my opinion, should not make individual decisions up to a certain level, which in fact should be quite generous. They should make or participate in portfolio decisions. How the portfolio decision is going to be made, that really depends on your objectives and so on. But once you have a specific portfolio allocation, not just how many companies will invest per year, how many dollars will invest per year, what specific strategic objectives, then we should give the CVC team the freedom to invest within those parameters. Do not wait for the approval on an individual deal. And that is very likely to lead to much more successful long-term implications.
Ilya, I think that this was a great example how you deliver on your promise to demystify venture capital in general and even just the breadth of insight into ICs within the context of corporate venture capitalists. I'm mindful of the time, and so I'd like to thank you for now. I would invite our listeners to either reach out to you or look at all the insights that you've generated and is posted as part of the Venture Capital Initiative. And thank you again for sharing this with the community that is part of your alma mater and the Institute of Entrepreneurship and Private Capital.
Absolutely. Thank you, Gary. Thank you for welcoming me back. LPS is very, very special for me. So I'm always happy to be back to my alma mater.